Assets can rise as long as QE rises along with it, but these are in nominal terms. In reality, nations that impose QE on the citizens are stealing wealth from savers and those on fixed incomes. Stocks can continue to rise in price as long as central banks print money. That's a fact. But in a very short period of time, the effect of that printed currency loses its muster and its value despite the number associated with it. You came here for the truth. Today we are going to discuss the 100% proof that QE will kill the stock market. That's right, you heard me correctly. Let's begin. This is the Japanese nominal GDP. Japan is regularly associated with the successful image of QE, and we know that to be false. For a full decade, Japanese GDP went sideways. This is a fact. And you can see that throughout basically the late 90s and onward, we had this stagnation. And instead of it rising afterwards, it declined. That's right. Despite all of the intervention, it declined. And after a few years of up and down, we can see that Abenomics has pushed this up to a new level. Of course, the economy isn't doing any better, but they were able to push up the GDP. Just like the US imposing Obamacare pushed up the GDP temporarily. There are an infinite amount of schemes that can be put in place. What we have here is central banks implementing policies in order to get the economy moving. And they fail every time. They never get the economy moving again, but they do have the ability to siphon wealth away from the savers and those on fixed incomes. They are very successful at that. Now, what else they've been successful at is making some very interesting looking charts. And that is the Bank of Japan total balance sheet. After the financial crisis, there was a bit of turmoil. You could see that the central bank decided to print some more currency. But it wasn't until, let's say, 2013 where we saw this ridiculous amount of money being printed under Abenomics, under the biggest experiment with quantitative easing that we have seen in a nation as big as Japan. They have printed so much, and the result of which has barely shown up. I can tell you right now that increasing the balance sheet is a temporary solution, but in the end will cause destruction. This right here is the Japanese stock market over the past 37 years. And what you will see, let's just say that this is today, it depends on the day you're watching this, but we are seeing a value which was also present right here in the late 80s, mid to late 80s. And the market had risen at such a dramatic level, this bubble that appeared. And what followed it was decades and decades of terrible performance. When you look at it in real terms, however, you realize that they have not been at this level in a much longer time. You can judge it in nominal terms. You can judge it in real terms. And both of them tell their own story. This is important to note that Japan is the model, not for success, but for failure. And they won't admit that failure. And as a result, they will suffer. They will continue to suffer. And the more currency they print, the worse off it will be. But that's just Japan. That will never happen in the US, you say. That won't happen here. Janet Yellen said, we will not have a crisis in our lifetime. Well, look at the Nasdaq. Today, it has risen past its previous high. You've seen that happen. So therefore, things are better than they were during the dot-com boom. That's what most people would say. That's what Jim Cramer would tell you because he's telling you to invest in stocks. That's what some individuals that shall remain nameless in the alternative media are telling you to buy these stocks. That's right. Well, not at the Money GPS, that's for sure. Look at this. We saw a huge rise up during the dot-com boom. Everything went bust. It came down. And over the years, it has increased. Now, over the past few years, particularly throughout 2017, we have seen things rise within the Nasdaq, within tech stocks in particular, let's say. And if you think about it, look at the fact that it took perhaps 15 years to reach the level that it was at prior. 15 years. So if you had bought in, because most people buy into a bubble near the top, but let's just take it from this point over here, okay, 3,500. Look how long it took, give or take 10, 12 years to reach that level again, where most people would have bought in if they were astute. They thought they were astute, let's say. Is that a good return that you would have to wait 12 years just to get back to where you were? You tell me. If you're buying in at the peak of the bubble, even if you weren't buying in at the peak of the bubble, and you bought in, let's just say at 2,000. Well, it took, right here, 10 years to get back to that point. 10 years of holding onto that stock, hoping it'd be worth something someday. You saw it rise up. You got really excited. You didn't sell, though, because most people don't know when to sell. And as a result, they were riding this wave, and they cried and cried, and many of them did some things I won't mention here, and it didn't end too well for them. So it took many years to come back. So that's what I worry about for a lot of people, because this has happened before and it will happen again. But when you factor in that we're talking about nominal terms, inflation adjusted, you get a different picture. In fact, today's stock market appears to be lower than where it was, and I'm just drawing an example, but that we are actually, in fact, at a lower amount today than we were prior in the dot-com boom. So many people need to realize this, that when you factor in for inflation, even the fake inflation number that they give us, after such a long period of time, you then have to realize that you're adding more time on to the end of that. So it's not really just a 10-year or 15, 12-year, whatever. It might be 20 years. And if we enter into a new recession, then what happens? But let's just say, even in inflationary adjusted terms, we have surpassed it. Okay, let's just say that. Then you get to that point. And let's just say, it's 2017, we've hit the mark, we've crossed it, we are now in profitable mode. Well, when's the next recession going to happen? 2018 maybe, 2019, even if it's just a 30 or 50% correction, nothing major historically. Then you have what, a year of growth, 2 years of growth? So many people have decided that they will sell at the perfect time. A lot of people right here, they're going to sell right at this moment here. They're going to sell right at this moment here. They're geniuses, and they'll do so. And they're going to do well. But the majority of people won't. There's always some people who are seem to know everything. Anyway, let's just move on here. Looking at this, changing gears a little bit. 50 stocks representing the largest short positions. We're talking about hedge funds in particular, but I just wanted to note these stocks themselves, not to really get into too much detail. Hedge funds, you can see where they're going. AT&T, Walmart, Intel, IBM, Exxon, GE, Target, and so on. Look at these companies which are being shorted right now. Quite the opposite from the companies which are being purchased up, gobbled up, like Alphabet, Apple, and Facebook and all those. Things have changed from the previous recession, and you'll notice here that all of the central banks, the hedge funds, the big institutional investors, they're all buying the same stocks. They're shorting certain stocks like this, and they're all buying the same stocks. That's what's pushing these all up. Everybody's buying it. The central banks are buying it. Everybody. So you can ride the wave, that's for sure. But the value of those dollars as time goes on, as more money is printed, it loses its muster. It loses its actual value instead of that number that's printed on it. If you just print $100 bills all day long, that $100 doesn't buy you anything anymore. Of course, the example, think about 100 years ago, what would $1 buy you? I'm sure you can get a nice meal for that. Now, you get nothing. There's not even items at the dollar store for $1. Did QE trigger the onset of the active runs of underperformance? Managers have consistently lagged behind their benchmarks since the start of QE. So it's a different way of looking at the Fed's balance sheet right here. So you can see the cumulative excess return versus the benchmark in terms of percentage. And this is the way they're doing it since the financial crisis and onward. The onset of the active's underperformance occurred shortly after the start of QE. It's something interesting to think about. What I would say is that when you are investing, I believe that everyone should do it on their own. You should be able to get a hold of this for yourself. You should be purchasing whatever that is on your own time, on your own discretion. Don't listen to me. Don't listen to anybody else. You need to do your own homework. That's why I show you the charts. That's why I show you the websites. I give you all my sources, and then you go out there and you do what you think is best. At this time, we are in a little bit of a critical mode. You can see what's happening out there, and I believe that we will encounter some hardship in the near future. So, if you found this video informative, please give me a thumbs up. And last but not least, if you found the video informative, I know you'll find my books, The Money GPS and my new release, Global Economic Collapse, even more informative. The first book, I get into a lot of the charts. I show you what QE is, and I get into the foundation, and essentially then I lead into the 4 asset classes and how to profit from them. In my newer release, I get into familiar topics, inflation, central banks, and others, and then I basically get into becoming self-sufficient, how we can do away with the monetary system altogether in what I call the Money GPS strategy. So you can look through those books at Amazon. Links are in the description below. Take care.